Pause for a second and really hear this. The financial breakdown isn't going to slam into the entire country at the same time. It's going to hit closer to home first, starting with your state. Before it becomes a national headline, it shows up locally. It shows up in rising property taxes, shaky public pensions, and questions about whether your bank is as stable as you assumed. All of that hinges on one uncomfortable reality. Is your state quietly sinking under a mountain of debt? We're not speaking in dramatic metaphors here. We're talking about genuine insolvency, the kind where funding runs dry, essential services start getting cut, and the cracks become impossible to ignore. In a moment, I'll walk you through the 7 U.S. states that, based purely on the numbers, are positioned to fall first. More importantly, I'll break down the practical moves you should be making right now if you happen to live in one of them. The next financial crash isn't some distant possibility. It's already built into the framework of the system. The warning signs are out in the open. Commercial real estate vacancy rates have climbed to 25% in major metro areas. Roughly $1.8 trillion in commercial property loans will come due in 2026, and many of them won't qualify for refinancing. Meanwhile, pension systems are sitting around 40% underfunded at the exact moment state revenues are beginning to shrink. This situation isn't a replay of 2008. It's 2008 layered on top of conditions reminiscent of the Great Depression, amplified by decades of unresolved debt that was never truly dealt with, only postponed. And here's the part most people miss. The pressure begins at the state level. That's where the arithmetic has already broken down, even though no official announcement has been made. If you genuinely want to understand which states are likely to unravel first, and what that could mean for your home, your tax burden, and your long-term financial security, subscribe now. Because by the time this becomes obvious to everyone else, your options may already be limited. Coming in at number 7, Kentucky. Kentucky's public pension system is only about 45.4% funded, placing it among the weakest in the country. To put that in perspective, the state is carrying roughly $43.7 billion in unfunded pension obligations, while its total state GDP sits around $247 billion. That means nearly 17.7% of the entire economic output of the state is effectively tied to retirement promises that currently don't have the funding to back them up. Now let's translate that into real-world terms. About 418,000 current and former public employees in Kentucky are counting on those pension checks. But when you run the numbers, they simply don't add up. The state can't slash benefits without running into constitutional barriers. It can't raise taxes high enough to close the shortfall without pushing more residents and businesses out. And it can't realistically grow its economy fast enough to outpace obligations of this size. Kentucky brings in roughly $14 billion per year in general fund revenue. Out of that, about $3.2 billion has to go toward pension costs just to keep up. That's nearly 23% of the budget consumed before a single highway project begins or one school district gets funded. When the next downturn hits, and revenues drop by 15 to 20%, which is typical during a recession, the state faces an ugly decision. Either it defaults on pension commitments, or it begins cutting core public services. There's no painless option. Kentucky also leans heavily on federal support. Around 35% of its state budget comes from Washington. If a broader economic crash forces federal spending cuts, that stream of money could shrink fast. That would mean revenue pressure from both directions at the exact same time. As the financial strain intensifies, property taxes are likely to surge as officials scramble for cash. It wouldn't be surprising to see increases of 20 to 30% within 3 years if the situation accelerates. At the same time, rising taxes and declining public services tend to push people out, which drags down home prices. If you own property in Kentucky, you're exposed on both ends, falling home values while your tax burden climbs. So what should you do? If you work in Kentucky's public sector, assume your pension isn't untouchable. Courts overseeing municipal bankruptcies have repeatedly shown that retirement benefits can be adjusted. Legal protections don't guarantee full payouts in a crisis. If you're already retired and relying on a Kentucky pension, start diversifying your income sources now. Plan conservatively, as though benefits could be reduced by 30 to 40% within the next 5 years. If you're a homeowner, consider selling while demand still exists and the market remains relatively stable. If you're renting, Try to secure a longer-term lease before landlords begin raising rents to offset higher property taxes. And finally, think carefully about where your liquid assets are held. Moving bank accounts and investments away from Kentucky-based financial institutions may reduce your exposure if local banks face liquidity issues once the crisis becomes undeniable. At number 6, we have New Jersey. New Jersey's pension system is funded at just 41.8%, which actually puts it in a weaker position than Kentucky. On top of that, the state carries about $21 billion in direct debt against a GDP of roughly $72 billion. That works out to a debt-to-GDP ratio of 28.6%, one of the highest in the country. But the deeper issue isn't just bonded debt, it's the pension gap. New Jersey is staring at approximately $111 billion in unfunded pension liabilities. That's the real pressure point. Residents are already paying the price. New Jersey has the highest average property taxes in the United States, coming in at around $9,284 per year. Those tax dollars aren't just funding schools and infrastructure, they're also covering pension costs, debt payments, and routine government operations. The problem is, there's very little room left to raise taxes without pushing even more people out of the state. And that migration is already underway. In 2023 alone, about 70,000 residents left New Jersey. Every departure shrinks the tax base, but the pension obligations tied to former public workers remain. The liabilities stay put, even as the revenue pool shrinks. The state's economic engine relies heavily on financial services, and that sector is facing significant disruption from AI-driven workforce reductions. If Wall Street firms eliminate 30 to 40% of mid-level management roles, New Jersey feels the impact immediately. Lost jobs mean lower income tax collections, and as displaced workers struggle with mortgages or relocate to lower-cost states, property tax revenue drops too. Credit agencies are already signaling concern. All three major rating firms have assigned New Jersey a negative outlook. When the next recession arrives, downgrades to near junk or junk status become a real possibility. That would make borrowing dramatically more expensive at the exact moment the state needs access to credit just to keep basic functions running. Here's where the cycle becomes dangerous. High taxes push residents out. Fewer residents mean less revenue. Lower revenue forces tax increases on those who remain. And those increases trigger even more departures. New Jersey effectively stepped into that feedback loop around 2018, and the pace appears to be picking up. So what does this mean if you live there? Expect property taxes to rise by 25 to 35% over the next 3 years, regardless of whether home prices move up or down. Even if your house holds its nominal value, your equity gets eroded by the growing tax burden. If selling is an option, doing so sooner rather than later may limit your exposure. If you're unable to sell, be prepared for difficult financial decisions down the line, especially if your annual property tax bill begins approaching or exceeding your mortgage payment, a scenario that could hit middle-class homeowners first. If you're employed by the state or relying on a New Jersey public pension, assume benefit adjustments are possible and plan conservatively. Consider opening accounts with financial institutions based outside the state. Review where your retirement funds are held and ensure they're structured in ways that limit potential state-level interference. And if you operate a business, relocating to nearby states like Pennsylvania or Delaware could offer meaningful tax advantages. The cost and disruption of moving may be outweighed by the long-term savings and stability. At number 5, we're looking at Connecticut. Connecticut is carrying roughly $78.3 billion in unfunded pension and retiree healthcare obligations, compared to a state GDP of about $325 billion. In other words, close to 24% of the state's entire economic output is effectively tied to promises that currently lack proper funding. Its pension system is only about 47.5% funded, which means more than half of the benefits that have been guaranteed to workers don't actually have assets backing them up. That's not a small gap. That's structural instability. The state has also experienced population declines for 5 straight years. A major vulnerability lies in its dependence on high-income residents, particularly those clustered in Fairfield County, hedge fund managers, finance executives, and other top earners who generate a disproportionate share of tax revenue. In fact, The top 1% of earners account for around 42% of Connecticut's income tax collections. When even a fraction of those individuals relocate, and many already have, the fiscal impact is immediate. The revenue base shrinks quickly, but the state's obligations don't shrink with it. That imbalance creates serious stress on the budget. Lawmakers have attempted to close the gap through higher income taxes, mansion taxes, and increased corporate tax rates. So far, those measures haven't solved the underlying problem. In many cases, higher taxes have simply accelerated the migration of affluent residents to states like Florida and Texas, where there is no state income tax. Connecticut is effectively dealing with tax base erosion in real time. The housing market reflects that pressure. In many parts of the state, property values have either stagnated or declined over the past decade. For example, the median home price in Hartford is around $200,000 today, compared to about $235,000 in 2007. That's nearly 2 decades of price deflation, even as property taxes have climbed roughly 40% over the same period. Many homeowners feel stuck, unable to sell at attractive prices while facing steadily rising tax bills. Economically, Connecticut leans heavily on 3 sectors: financial services, insurance, and healthcare. Each of those pillars is facing disruption at the same time. Finance is contending with AI-driven restructuring and job reductions. Insurance firms are consolidating operations. Healthcare providers are bracing for potential federal funding cuts. When all 3 core industries are under pressure simultaneously, the broader state economy becomes fragile. So what does this mean for you? If you're in the top income brackets in Connecticut, understand that you represent a large share of the state's tax base. Relocating to states like Florida or Texas, and properly establishing residency, could significantly reduce your tax burden. Keep in mind that Connecticut closely audits individuals who claim to have moved, so any transition needs to be documented and legitimate. If you're middle class and own property, consider your timing carefully. The housing market risks entering a downward cycle where sellers outnumber buyers, prices soften, and taxes continue climbing. If you work in finance or insurance, recognize that your industry is going through structural change. Downsizing and consolidation are real possibilities, so having a contingency plan is wise. And if you're relying on a Connecticut public pension, plan conservatively. Preparing for potential benefit reductions of 30 to 40% within 5 years may not be overly cautious. Diversifying assets outside the state and building relationships with out-of-state financial institutions could offer additional flexibility. Number 4 is Hawaii. Hawaii's financial outlook stands apart from other states because of 2 defining factors: its physical isolation and its overwhelming reliance on tourism. That combination creates an unusually fragile setup. The state is carrying roughly $29.6 billion in unfunded pension and retiree healthcare liabilities, compared to a GDP of about $102 billion. That means close to 29% of Hawaii's total economic output is effectively tied to obligations that don't currently have funding behind them. On paper, the pension system appears to be about 52.7% funded. But that figure rests on an optimistic assumption that investments will generate annual returns of around 7%. In a severe downturn, those returns are unlikely to materialize. If actual performance averages closer to 3% or 4% during a prolonged slump, the funded ratio could fall sharply, potentially landing in the 35% to 40% range. The bigger vulnerability is the structure of the economy itself. Hawaii depends heavily on tourism, and tourism is one of the first sectors to contract during recessions. When unemployment rises on the mainland and households start tightening budgets, discretionary travel is often the first expense to disappear. During COVID, tourism to Hawaii dropped by roughly 70%. In a deep recession, declines of 40% to 50% would not be surprising. Unlike more diversified states, Hawaii doesn't have many alternative economic engines to fall back on. When tourism stalls, the ripple effects spread quickly through restaurants, hotels, retail, transportation, and real estate. If the visitor economy weakens, the broader state economy weakens with it. At the same time, the cost of living in Hawaii is about 88% higher than the national average. Housing costs run roughly 200% above average, and groceries are around 50% more expensive because most goods must be shipped in from the mainland. When incomes fall during a recession, residents face a harsh squeeze. Daily life is extremely expensive, yet relocating off the islands isn't cheap either. Moving a family from Hawaii to the mainland can cost anywhere from $8,000 to $15,000. Geographic isolation also changes the dynamics of capital flight. When high-income residents decide to leave Hawaii, they typically sever ties completely. There's no practical way to commute from California or Nevada while maintaining a primary residence in the islands. Once those taxpayers depart, they usually don't return, and the revenue they generated leaves permanently. So what are your options? If you live in Hawaii and don't have the financial reserves to withstand a multi-year downturn, it may be wise to evaluate relocation sooner rather than later. The high cost of living becomes especially punishing when income declines. If you own property, consider the timing carefully. While tourism is still active, there are buyers. Once tourism contracts significantly, demand for vacation homes and investment properties can dry up quickly. In a recession, tourists don't purchase second homes, and local residents often can't afford them. Property values can fall sharply when both groups step back. If you work in tourism or hospitality, recognize that your industry is typically hit first and recovers last in an economic slump. Having a mainland relocation plan, along with sufficient savings to execute it, could make a major difference. And if you depend on a Hawaii state pension, prepare conservatively. Significant benefit reductions, potentially around 40%, are possible if investment returns underperform and fiscal stress intensifies. Diversifying your income streams now may help cushion that impact. Number 3 is Illinois. If any state represents long-term fiscal strain at the state level, it's Illinois. The state is carrying roughly $317 billion in total debt against a GDP of about $1.06 trillion. Its pension system is funded at only 42.4%, placing it among the weakest in the country. Unfunded pension liabilities alone add up to around $139 billion. Chicago, which serves as the economic engine of Illinois, is under significant pressure. Between 2010 and 2023, the city lost approximately 260,000 residents. At the same time, downtown commercial real estate vacancy rates have climbed past 24%. That signals reduced business activity, lower property values, and shrinking tax collections. On top of state obligations, the city of Chicago itself holds roughly $42 billion in separate debt. So there's layered financial stress, municipal and state, both pulling in the same direction. Illinois also carries the second lowest credit rating of any U.S. state, hovering just above junk status. Because of that, it pays higher interest rates to borrow than most states, in some cases even more than large corporations. As borrowing costs rise, a growing share of the state budget gets diverted toward debt service instead of funding schools, infrastructure, or public safety. Property taxes are already high, particularly in Cook County. Between 2010 and 2023, property taxes there rose about 35%. Looking ahead, increases of another 30% to 40% over the next 5 years are plausible if the state continues trying to plug pension gaps while population declines persist. And the population decline is real. From 2020 to 2024 alone, Illinois lost roughly 344,000 residents, essentially the equivalent of an entire small city leaving. Every person who moves away reduces the tax base, but pension liabilities remain fixed. That imbalance creates a powerful downward spiral. Complicating matters further, Illinois has strong constitutional protections for public pensions. The state constitution explicitly prohibits reducing promised benefits. That means lawmakers cannot simply trim obligations to stabilize finances. The only structural reset would likely require some form of bankruptcy or federal-level intervention, and there's no guarantee that support would materialize. So what does that mean for you? If you live in Illinois, particularly in the Chicago metropolitan area, recognize that the state faces one of the most challenging fiscal positions in the country. If you own property, consider your exposure carefully. Continued tax hikes combined with ongoing population losses could pressure home values over the next several years. If you operate a business, relocating to neighboring states such as Indiana, Wisconsin, or Iowa may offer a more stable tax environment and steadier demographic trends. If you rely on an Illinois public pension, plan conservatively. In a severe restructuring scenario, benefit reductions could be significant. Preparing for potential cuts of 50%, or even more in an extreme case, may not be unrealistic. You may also want to review where your liquid assets are held and consider establishing banking relationships outside the state. If fiscal stress intensifies, policymakers could explore aggressive revenue measures, including new taxes or restrictions. And if you're young, flexible, and able to relocate, weigh your long-term opportunities carefully. Mobility can be a powerful advantage in uncertain environments. Number 2 is California. California is often described as too big to fail. Yet size alone doesn't guarantee stability. On the surface, the state's $54 billion in direct debt compared to a $3.9 trillion GDP looks manageable, roughly a 13% debt-to-GDP ratio. That seems reasonable at first glance. But the deeper strain isn't sitting in traditional bonded debt. It's embedded in pension commitments and years of deferred infrastructure maintenance. CalPERS, the state's primary public pension system, reports a funded ratio of about 71%. That sounds stronger than many other states, until you look closer. The system oversees approximately $477 billion in assets against roughly $674 billion in liabilities. That leaves a shortfall of about $197 billion, a gap larger than the entire annual budgets of most states. And those projections assume annual investment returns of 6.8%. If markets turn negative during a major downturn, that funded ratio can deteriorate quickly. Pension math that works during bull markets tends to break under sustained losses. At the same time, California has been losing residents. Between 2020 and 2023, nearly 700,000 people left the state. Many of those departing are high-income earners, and that matters because the top 1% of taxpayers account for roughly 50% of California's income tax revenue. When affluent households relocate to states like Texas or Florida, the state's revenue structure takes a direct hit. California also relies heavily on capital gains taxes, particularly from technology sector wealth. When stock markets decline and tech valuations contract, state revenue can fall sharply. That pattern played out in 2001 and again in 2008. A severe downturn can reduce revenue by 30% to 40% in a short period, creating sudden budget gaps. Beyond pensions and tax volatility, there's another layer: infrastructure. California faces more than $200 billion in deferred maintenance and infrastructure obligations. Roads, bridges, water systems, and electrical grids require ongoing investment. When funding is diverted toward pension obligations instead of maintenance, deterioration accelerates. And when infrastructure fails during a crisis, emergency repairs often cost 2 to 3 times more than proactive upkeep would have. San Francisco offers a clear example of localized stress. Office vacancy rates exceed 36%, and commercial property values have fallen roughly 41% since 2019. Because the city's budget depends heavily on property tax revenue, falling valuations and loan defaults are eroding its fiscal base. In that sense, San Francisco faces financial strain that could unfold independently of broader state-level issues. So what should you consider? If you're a high-income earner in California, recognize that you represent a substantial portion of the state's tax base. If relocation is part of your plan, establish residency elsewhere carefully and thoroughly. California closely scrutinizes individuals who claim to have moved. Documentation and compliance are critical. If you own commercial real estate, evaluate current valuations and long-term demand trends realistically. Recovery in certain office markets could take years. If you hold residential property in high-priced coastal cities, pay attention to the buyer pool. Foreign investment and high-income migration have supported valuations in the past. Shifts in capital flows or policy could affect that dynamic. If you depend on a California public pension, plan conservatively. In extreme restructuring scenarios, courts have demonstrated that contractual protections can be revisited. Diversifying income sources may help mitigate risk. And if you operate a business, states such as Nevada, Texas, or Arizona may offer lower tax burdens and faster population growth. Evaluating geographic flexibility now could provide long-term strategic advantages. Number 1 is New York. New York ranks as the most exposed state in the country, largely because its economy leans so heavily on one dominant sector: finance. And that industry is facing profound disruption from artificial intelligence. On paper, the state carries about $41 billion in direct debt against a $2.1 trillion GDP, not catastrophic by itself. It also reports roughly $52 billion in unfunded pension liabilities. But the real pressure point is New York City. The city generates close to 60% of the state's total tax revenue. If the city stumbles, the state stumbles with it. Manhattan's commercial real estate market is already under strain. Office vacancy reached 23% in 2024 and continues trending upward as companies reduce footprints or decline to renew leases. Return-to-office efforts have largely failed. Remote and hybrid work models are sticking. Meanwhile, Wall Street firms are aggressively automating white-collar roles. Industry estimates suggest that 40% to 50% of certain positions could be eliminated through AI-driven systems. These weren't low-paying jobs. Many carried salaries between $150,000 and $400,000 annually and generated enormous income tax revenue. As those roles disappear, so does a major portion of the tax base. Large institutions are restructuring operations around automation, and the reductions appear structural rather than temporary. New York City operates on an annual budget of around $110 billion. A significant share of that funding comes from commercial property taxes. If office buildings remain 40% vacant and assessed values fall by 50%, the resulting drop in property tax revenue creates an immediate fiscal gap. New York already imposes one of the heaviest overall tax burdens in the country, second only to California. Property taxes, income taxes, and sales taxes are all near practical ceilings. Raising them further risks accelerating the outward migration that is already underway. Between 2020 and 2024, roughly 550,000 residents left the state. The pension situation looks stable at first glance. New York reports a funded ratio of about 94.5%, but that assumes annual returns of 5.9%. In a severe market downturn, say a 40% decline followed by a slow recovery, that ratio could fall to the 60% to 65% range. That shift would expose tens of billions in additional unfunded liabilities almost overnight. New York City alone carries around $200 billion in debt, more than most U.S. states. Its budget depends heavily on three pillars: commercial real estate taxes, income taxes from the financial sector, and tourism. If all three weaken at the same time, the fiscal stress compounds quickly. Here's how the cycle unfolds. Finance jobs disappear. High-income residents relocate to states like Florida or Texas. Luxury real estate demand falls. Property values decline. Property tax revenue shrinks. Public services get cut. More residents leave. The loop reinforces itself. The Metropolitan Transportation Authority adds another layer of strain. The MTA holds roughly $50 billion in debt and continues to experience lower ridership due to permanent remote work patterns. Ridership remains about 30% below pre-pandemic levels and may never fully recover. The transit system faces its own financial crisis, independent of the city and state. So what should you consider? If you work in New York's financial sector, recognize that automation risk may be greater than it appears. Update your skills, refresh your resume, and maintain geographic flexibility. If you're a high-income earner, monitor policy discussions carefully. Proposals such as wealth taxes or exit taxes have surfaced before. Any relocation strategy should be well documented and compliant with residency rules. If you own commercial property in Manhattan or other central business districts, assess long-term demand realistically. Office recovery could take a decade or longer. If you hold residential real estate in New York City, understand that buyer demand depends heavily on both domestic and international capital flows. If those flows slow, liquidity declines. If you rely on a New York public pension, Avoid assuming that current funded ratios guarantee future payouts. Diversifying assets and maintaining banking relationships outside the state may provide flexibility. For business owners, states with lower costs and growing populations, such as Utah, Idaho, Tennessee, Texas, Florida, or North Carolina, may offer more stable operating environments. Across all 7 states discussed, common warning signs appear. Unfunded pension obligations exceeding 15% of GDP, sustained population losses since 2020, reliance on industries facing technological disruption or cyclical contraction, limited capacity to raise taxes without shrinking the tax base further, and credit ratings already under pressure. If a state-level fiscal crisis unfolds, the consequences are tangible. Property taxes can surge while services decline. Pension benefits can be reduced,